You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options. Facebook.com/TheOptionsInsider or via questions at TheOptionsInsider.com.
It's time for Volatility Views, the premier program for volatility traders. Each week, we'll take a deep dive into the world of volatility with in-depth analysis, trading activity reviews, strategy breakdowns, cutting-edge education, and much more. We'll also bring you exclusive conversations with the traders, researchers, and asset managers who are reshaping the volatility landscape. If it involves volatility, then you'll find it on Volatility Views. Volatility Views is brought to you by Russell Investments, home of Russell Indexes, which calculates approximately 700,000 benchmarks daily, covering 98% of the investable market globally, including more than 80 countries and more than 10,000 securities. Approximately $4.1 trillion in assets are benchmarked to the Russell Indexes. For more information on Russell Indexes and RVX, please visit russell.com/indexes. And now it's time to take a deep dive into the world of volatility. It's time for Volatility Views.
Welcome back to Volatility Views, the premier program for volatility traders. My name is Mark Longo from the OptionsInsider.com, as well as from the ever-exciting Options Insider Radio Network. 13 programs on the old network. Where can you find all of those volatility and options and all sorts of fun products and programs there on the network? Well, of course, the mothership, the flagship, theoptionsinsider.com. Click on the Insider Radio Network tab, and you're pretty much off to the races. You've got the whole thing at your fingertips. If that's too much for you, then, of course, surf on over to iTunes or TuneIn or Stitcher or wherever you like to find your podcast programs. Even pull them into your own podcatcher. We don't frown on that. Whatever you like to use, Pocket Cast, Downcast, Double Twist, whatever your flavor of choice is, we smile upon that as well. Just grab the RSS feed, also available on the site there, and you're off to the races there. And again, if all that's too much for you, just grab our mobile app, available for the iOS, Android, and even the Amazon app stores. And of course, while you're doing that, send us your questions, your comments. We love to hear from you guys while you're listening to the show. Maybe afterwards you have some questions, some comments. Let us know. We love to hear from you guys, because really that's the reason we do these programs, is for you guys out there in the listening audience. And joining me on the old program today, starting off, is my volatility compatriot, the devious and dastardly greasy meatball himself, Mr. Mark Sebastian from Option Pit, as well as his myriad appearances on the old network here. Mr. Greasy Meatball, welcome back to the Volatility Views program.
Things are great, Mark. Kind of an interesting day in the markets, but it's been a fun couple of weeks if you're into volatility trading and all sorts of exciting events going on. So I'm looking forward to talking today.
And if having two Marks on the show wasn't confusing enough, listeners, we've added a third Mark into the mix, and a Mark S indeed. So two Mark S's if you're playing the home game there. He is Mark Shepard, an old friend of the show. He hasn't been on in a while. He is the founder of the Derivative Strategy Consultants, a former market maker over there on the SIBO. Mark, other Mark, or should we call you Shep, whatever you prefer there. Welcome back to the Volatility Views program.
Hey guys, thanks a lot for having me on. It's a pleasure to be such a distinguished panel, especially Mr. Greasy Meatball. And as Mark said, lot to talk about today. The markets have been absolutely on fire, both from a macro and idiosyncratic risk perspective. So really looking forward to the show today. And
before we get into it, you have been on before, but it has been over a year, so I'm sure we have some new listeners out there who aren't familiar with what you do. Why don't you go ahead and give them a quick overview of what it is that you do over there at Derivative Strategy Consultants?
Absolutely. Derivative Strategy Consultants provides outsourced strategy and risk measurement solutions, primarily focusing on institutions, and we work on options, option overlays, and macro asset class plays for those types of investors.
All right, good stuff. Check them out over there at Derivative Strategy Consultants if that sounds like some services that you may want to avail yourself of. But in the meantime, it's time for us to kick off the show. It's time for the Volatility Review.
It's time to break down the latest developments in the volatility trading world. It's time for the Volatility Review.
All right, and welcome to the Volatility Review. This is indeed the portion of the program where we break down what's moving, what's shaking in the old markets. And it was indeed a pretty active week, and it continues to be an active session today. We are recording this Friday, July 24th, for all of you there playing the home game. And as Mark, the other Mark, Mr. Shep, I'll call him, alluded to, we are in sell-off mode yet again on the street. Despite some decent earnings yesterday, the commodities seem to be weighing on the market pretty heavily. S&P off nearly a full percentage point, nearly 19 handles. The Dow also closing in on that range, nearly a full percentage point as well. The NASDAQ 100, a bit of a laggard this time, only off a little bit more than half a percentage point. And all this downside love means some vol is creeping back into the marketplace. So it seems like we might be heading into perhaps a languishing period out there from a volatility, from a VIX perspective. And at least here towards the end of the week, not so much, bouncing off the 12 handle out there in the VIX Cash. As we are recording this now, we're north of the 14 handle, 14.2 out there in VIX Cash. So getting a little bit of love there in the near portion of the old VIX curve. But let's start off, Mark, actually, Mr. Shep, since this is your first time on the program in quite a while, I'll give you pride of place. Why don't you go ahead and give us a bit of an overview of what caught your eye this week from a volatility perspective?
Sure. From a volatility perspective, I've been working on Micron, and I know that the earnings came out a couple of weeks ago, but I'm actually looking at the implied at a 52-week high right now, north of 50, and been working on some investment strategies for a client, and just working on specific managing to a return of option premium. They're potentially looking to sell some premium, both puts and calls, and trying to come up with some strategies and send them some visual P&L points to let them better understand what we have going on here. So I think Micron from a tech perspective is certainly something from a singular portfolio point of view that I've been working on this week. Secondly, as you just said, the VIX is trading a little bit over 14 right now as we speak, and we're looking at a total portfolio coming off of 1150, I believe, earlier in the week. And I would just be have been advising clients to gradually get back in with either the July DEES or July SEP future spreads to work on specific managing aspects in their portfolio for putting futures to work. And especially with where VIX came from, almost 20 2 weeks ago, I think it's certainly time to start adding bits and pieces to the portfolio, just in case we do have a deflationary spiral coming forward.
And Mark, is that a typical client for you? They coming to you a lot these days for single names looking to harvest premium, maybe mitigate some volatility for a concentrated stock position? Or is it more of the large funds type who are looking for maybe some more broad volatility type hedging and exposure? Where do the clients typically break down for you?
Sure. Much more of the former than the latter, I should say. Sometimes, or a good deal of time, there is idiosyncratic risk. And what we're really trying to do is look at the tea leaves, obviously, that the options markets give us, and make a good, educated guess whether we back test and whether we front test with specific positions that could be put on. Then that is how we will counsel the client to make sure that they understand how the stock has behaved before and can act, going forward with specific option strategies.
Seems like old school tech is making a comeback. I haven't thought about Micron in quite a while. People writing in about IBM recently, EMC. It seems like some of the old school tech names are starting to make a resurgence, at least from a overall listener and reader interest level here on the old network. Other Mark S, aka the Greasy Meatball, same question for you. Obviously, a very active week from an overall volatility perspective. So, what in particular caught your eye out there, sir?
Yeah, volatility kind of got overdone, and I think we made a comment on this on Option Block earlier in the week. I said, earlier in the week you could buy fall risk at summer prices, and apparently that has been somewhat fixed. The VIX is now back to what seems like a relatively logical level. There's still some risk in the market. I don't think we're going to fall out of bed here. I don't think anybody does, but there's definitely some groups that are being basically forced to sell commodities, and lots of commodity groups are kind of hedging and taking a lot of risk off. So I think that you've got a scenario where we're in a little bit of a panic sell-off on the commodity side, and it's pulling the S&P down with us. I would be shocked if maybe gold's the only one that doesn't go down, but where if we don't see some buying in the commodities. I mean, deflation is we are potentially in some sort of deflationary period. I think that's something to give the Fed something to worry about before they raise rates.
As people who have been focused on, the Fed, will they, won't they dance? There are so many other factors coming into at play to complicate that equation and probably perhaps pushing that decision even further. Those people who have been holding on to
I wonder who said that.
Maybe a Dees decision point. Maybe now that's moving past. We'll see. Although Miss Yellen still at least clinging to that they're going to act this year. I think just for no other reason than to keep themselves in the discussion. Otherwise, who's gonna pay attention to anything she has to say until next year? But speaking of VIX land, there was some interesting developments out there. We usually chat about VIX Futures at this portion of the program, and we have a new addition to the VIX Futures family this week, just listed recently. We've been talking about them for quite some time. The weekly VIX Futures finally coming online this week, and granted, we only have a session or so under our belts so far, and so far the early sessions seem to be all right, maybe a little bit lighter than expected. I'm looking at some of the numbers here for yesterday, the 23rd. Seems like we had about 200 odd contracts total, and open interest of about nearly 101 and about 30 in the other. So perhaps not lighting it up to the way certainly this has been getting a lot of buildup. Even VXST also got a similar lead up to a lot of talk about it leading up to the launch. That at least did some decent paper in the early go around before it kind of withered and died. We'll see, again, only a small sample size at this point to really judge by, but usually these products kind of come out strong out of the gate and then they kind of tamper off a little bit, and they maybe come back when they find some traction. We'll see if perhaps this one is going to catch on. Maybe Mr. Shep, we'll start with you again because Mark and I have been chatting about these for a while. Is this a product that at all interest you from a portfolio management hedging perspective? And we've been talking here on the show quite a bit how the trend in every product is towards short duration, and volatility. It seems like it hasn't really resonated, at least with the main VIX products. They haven't really found their groove, created a product that seems to resonate, perhaps because it's that institutional clientele. Maybe they don't want it. I'm curious, you deal with a lot of the institutional clients out there. What's your take on the nearer term, essentially weekly VIX products? Think there's a use case for them? Are you interested in them, or are you really not that intrigued by these products?
Yeah, I think as a prop trader back in the day, I think these would be very interesting. However, I think we're going to need to see a period of heightened VIX. I'm talking anything over 18, something like that, for these to really come to fruition. But I think from a prop trading standpoint, putting together and modeling your algos, some of those strategies would be very useful in something like this. But from an institutional perspective, I think some of these products just may be a little too short term, because you're going to have very immediate access to the chief investment officer, and they may or may not want to take an extremely short term position to hedge out of a specific target. They may need to have some more time and thoughtful process than just day by day by day by day. So I think from an institutional standpoint, maybe not so much, but it really depends on the type of fund. Now, an institution that has in-house capability, has in-house options traders and strategists, that could possibly be something that they could use. But for a foundation or endowment that outsources that type of role, I don't see that being a particularly useful item.
So popular with the spread trading community, the active traders, the prop shops, like you said, but not so much with the end users, the end consumers of a lot of these volatility products.
I think you're correct.
Mr. Other Mark S, Greasy Meatball. You've been watching these for a while too. What's your take? Obviously, only a few days here out of the gate. I think a day and a half here. What's your take on the early sessions?
I mean, so they, yesterday they did a couple hundred. Today they're already have traded over 300 contracts. So it's already more successful than any other product except for VIX. So the mission accomplished, SIBO. You came up with something that people will trade, and so there's definitely people trading it out of it. Definitely spread traders are interested in it. Where I think we could see some real uptick. Don't be surprised if we actually see that thing catch a lot of volume into things like non-farm payrolls, which will be so I could see like the AUG, the one that the AUG 7, the AUG 12 could be a real interesting one, because that's going to encompass a lot of risk associated with non-farm payrolls. So I think that there is an institutional use case, but yeah, any of the outsource groups are not going to be interested in doing it. But those that are in house, some of the real big funds, they may be willing to bite.
And of course, we only have the futures listed now. The options are going to come down the road at some unspecified date, depending on the success of these.
I ran into an unnamed SIBO person that said they've got the OCC has some questions about how the options might work.
So that'll add another 2 months to the listing process.
I thought we were going to get them right away, but it looks like the options are going to take a little longer.
Yeah, I was hoping a few weeks, but it sounds like if there's OCC is involved, then that's going to take a little bit longer. And of course, that'll probably attract more.
OCC's probably worried about counterparty risk, is my guess.
I can understand that. I can certainly understand that.
I can absolutely understand it.
And maybe some symbology issues. They love that kind of stuff over there. But yeah, I think when the options do list, when and if they do list, that'll obviously attract more of the active trader crowd. Obviously, we're looking at a subset right now. We're looking at the people who are looking at near-term volatility who also trade the futures, which we know is a pretty small subset. A lot of the people who trade the futures are on the longer end of the curve. So like Mark said, they're the more of the end users and they're end consumers of vol and Vega, and they're not really that interested in this kind of high-end, high flagellation portion of the curve, whereas the retail guys are and the active traders are, and they tend to gravitate more toward the options. So I think when and if we do get the options listed, I'm going to lean more towards the when than the if. That will probably tell more of the tale of the interest in this, because right now, how many people out there who are slinging the near-term futures? There's interest in that, clearly. It's been interesting to watch the coverage of this too, because it kind of dovetailed a lot with what we saw with the VIX up, VIX down recently. They kind of played it out as yet another way to try to get you closer to that ever elusive spot VIX and how it moves and the gap between the futures and the options and what's going on in the cash and et cetera, et cetera. So we'll see. That certainly is an argument that will resonate, particularly with the retail audience who want to trade what they see on the CNBC screen. And so perhaps that will drive some volume. Again, early sessions, you're right, today so far beating the doors off yesterday. So if that's the case, then perhaps we have a hit product on our hands. Time will tell in this one. We know to be patient when it comes to the near-term volatility game, because most of the products out there, unfortunately, haven't really resonated with the core audience yet. Moving on to a product that has resonated, of course, that's the big VIX Options, the mothership product out there, and it is doing another solid week so far. And today, again, today's about a decent volume day, not perhaps as strong as you might expect, given a pretty much 1% sell-off in the marketplace. I guess that's kind of becoming commonplace again here over the past few weeks. Not as strong, certainly not as robust as last week when we had the 2.2 million contract day. That was kind of an aberration out there, but still a relatively solid day. Week, most days over 600 or so thousand contracts. The call is starting to lighten up. up a little bit, not as heavy, and certainly not in the 4 range like we were when VIX Cash was a little bit higher. Now we're heading about 2.9 calls over puts, so people unwinding some of those having come off with the cycle as well. And in terms of what's the hot contract, actually, before we even get to that, Mark, Mr. Shep, do you utilize a lot of the VIX options products and any of the overlays and things you're doing for a lot of your clients? Is this a product that you pay attention to and use a lot, or is it, like you said, mostly on the single name side?
It's a very popular product because everyone, of course, has heard of it. It's very easy to model, and it's a great teaching point as well. So it's something that I can certainly bring to the table, either in a one-off strategy or in a specific derivative overlay, if you will. It's very tangible to what everyone thinks. It's just a matter of being able to integrate it in a proper way for a client. So sometimes we may be looking at an ETF version rather than a futures version or a futures options version, and it's that integrative approach which I need to be very careful about. But from the VIX product per se, it's a very popular product and something I work with on a daily basis.
So you're saying you lean more in the VXX realm than the VIX options per se?
I think so. Yes, absolutely.
That's what more the clients. So clients aren't coming to you in this day and age and saying they're having a lot of mind share and name recognition of VIX and asking for VIX directly. You're more pushing them in the VXX camp.
For institutional investors who have portfolios with large amounts of ETFs, it just makes sense to be able to use another ETF from a risk mitigation and measurement purpose. It just lines up a little better from that perspective. But certainly from an options overview, if a hedge fund or something like that came to DSC and asked for that specific type of model, that could very easily be done as well.
And on the VXX side, not to dive too deeply into this, we can get into this later, but on the VXX side, what's your typical holding period for something like that? Because a product like that obviously tends to wash away in your hands if you hold it too long, obviously.
Yes, it does. Short, it would really matter, such as we've been pretty active around the 12 half, and 13 level, and holding. Can certainly hold for a month to two. But certainly, as you said, your gains have to be very proactive in nature, and that's why we put very systematic profiles in place with the brokerage units that we use.
Interesting stuff. We've talked quite a bit here about VXX on the program, and of course the issues therein with that product. It certainly has its use case, but yeah, it also has myriad detractors too. We usually talk a lot about VIX here on the program, but as you mentioned at the top of the show, Mr. Shep, that there is a lot of vol in a lot of other places, including we are in the heart of earnings season right now. So I think we'll look a little bit farther afield. Some of these single names that have been lighting it up. That certainly has been a lot of the movement until the commodities kicked it in this week. That certainly has been where a lot of the movement in the marketplace of late has been coming from. A lot of the volatility we've been seeing is in the wake of these kind of earnings blowouts to the upside and to the downside, for lack of a better term. We had Google, of course, lighting it up. Amazon last night gunning up north of 80 handles for a while there. We were mocking on the option block program yesterday someone who had lit up the 570 calls on Amazon. They were about 80 handles out of the money, and then it turns out they worked out pretty well.
They were really close.
Yeah, they broke through it.
They were doing pretty well.
They broke through it during the show. Towards the end of the show, they were about 4 handles in the money. So yes, I had to eat my words there a little bit. Even the screwballs can look good on a day like that. But yeah, so there has been a lot of vol, a lot of just blowouts out there. Mark, you said you were looking at Micron earlier. A lot of your clients, how has this earnings season been impacting your clients from a portfolio and a hedging perspective? Is all these dramatic? Do you do a lot of earnings portfolio construction? Is that where a lot of your time comes? And if so, what's the past couple of weeks been like for you and your clients out there, with people just ripping up to the downside and upside on an almost daily basis?
Sure. It is a good amount of time, but as with any sport that we play, it's preparation and being able to have good information, good data analysis to be able to back test, to be able to make sure we understand where the earnings or where the stock is valued from an option sense, and then take advantage of where we think things are priced or mispriced. And certainly in the case with Micron, we were looking at buying a straddle, which worked out very well pre-earnings, even though from a technical perspective, Micron looked pretty bad going through the 50-day moving average, and also with Goldman Sachs coming out with a downgrade 2 days before earnings. Now, I think everyone remembers when we used to trade in the pit, when Goldman Sachs came in and offered a downgrade, we might have gone to the bathroom for 2 hours or something like that, So we always thought that they knew something that that we didn't. So we were very able to take advantage of positions at that time. We thought that volatility was cheap or inexpensive compared to how the market had been treating it in past times. So we were definitely able to take advantage in that scenario. I haven't been too active in Amazon, but certainly Apple is one of the bigger names for idiosyncratic risk, and also as a proxy for the overall market and the consumer, both here in the United States and China. So that's one that I will sometimes look as a proxy to the S&P, just because of its size and ability to compete.
Apple, that's a good one to bring up because everyone out there seems to have an interest or a position in it. And they, of course, came out earlier this week, and they were one of the other ones that was moving pretty aggressively to the downside this time. Going into the earnings, they had priced in about a 4.7% move there, and that straddles about a little over $6, I believe, with the stock around 131. Opened up nearly 9 handles to the south after that earnings and kind of regained about half of that on the way down. So it was indeed yet another example of pretty much what we're seeing a lot of this cycle, at least in the big names, and some of the smaller names, they're, in aggregate, the numbers wise, they're still probably performing well in tunes to their straddles. But the big names that get a lot of, mind share on the media outlets, and whenever the announcements are out, the Microsofts, the Apples, the others, are certainly a lot of those are moving pretty dramatically. Microsoft probably the one example that didn't. They priced in about a $2.50 move or so, about 5%. They got about $2 out of that one. So that one of the few that's underperforming. I mentioned Google earlier. Google just blowing the doors off, about 4x to the upside. I think they were pricing in about a 3.5% move. It worked out to about 21 handles. They got somewhere around 80, so about 4x of what they had been pricing in. Something similar out there, actually about 2x on the Amazon side. They had been pricing in, I believe, about a 45 handle or so move out there. They got somewhere around 80 as well. And of course, today, as we're following up here, giving back some of that, but still up nearly 60 handles. And the day when the market is off 1%, there are certainly worse things. Mark, like you said, your people out there in the pitch chat have been pretty active during the earnings season. We discussed Apple, we've discussed other ones. What's really been catching your eye? And are you starting to buy into this narrative? Bless you. Are you starting to buy into this narrative of essentially we're starting to see people perhaps build a little bit more juice into some of the announcements going forward, given how much we've seen on the blowouts, some of the other big names?
You'd hope so. I mean, the next big one that could really blow things up is Facebook, which reports next week. Mark, and we, again, we talked about it. I hate to sound like a broken record, but I feel like a lot of the big thing we're seeing is some of this social media and content delivery is really what's blowing things out. I mean, Comcast is another name that it really did well, and they deliver content. And so, I'm looking at Facebook, and that straddle's expanded now to almost $10. So it went from about an 8% straddle to now just about 10%. So it's we're definitely seeing those things expand some as people realize, oh wait, there's not edge in selling premium and NASDAQ stocks. That went away a long time ago, folks. So that's that would be my advice.
Yeah, the Goog, Amazon, Apple, Netflix, et cetera, effect starting to be felt in the latter portion. And this is actually kind of nice. It's been a while since we've had an earnings season that injected this much life back into the scene. The last few have been a resounding mess, for lack of a better term. And seeing a little bit of life, at least in the early reporters here, is kind of nice. Selfishly, from an options perspective, we like a little bit of vol, we like a little bit of action in the marketplace, and this certainly is delivering. And moving on to some of the other products, there's so many areas that are exhibiting vol and life. Typically, we dive to crude right now, but I want to dive into the product first that really seems to be catching a lot of mind share these days. Certainly weighing on the marketplace of late is, of course, gold, taking it on the chin of late, selling off fairly aggressively, seeing some little bit of a spike in the much maligned GVZ that is indeed the gold VIX product, hovering around at about 19.4 right now, gaining nearly 5 handles over the course of the week. So a lot of vol creeping in out there in the gold product. That, of course, tracks the GLD ETF, not exactly the futures options, but the futures options also exhibiting what you might expect out there of late as well. Of course, given the explosion of activity out there, explosion of downside move, we're seeing a sharp steepening in the volatility skew out there in some of the nearer term products. But as our guest from Typhon alluded to last week, once you kick the can a little bit beyond the frothy end of the curve, it seems like looking at the skew chart here, this seems like there's a little bit more saner heads, calmer heads are prevailing out there in gold land. You get beyond the nearer portion, the nearer options where the puts are just ridiculously priced. You're starting to see certainly a premium to the puts, but nowhere near as hefty as you might expect. And actually some love to some upside calls as well. People saying, hey, you know what? There's perhaps a reversal in the near future. And some of that is, of course, the gold bugs. They're perhaps worse than the Apple and Facebook zealots out there. All they can do is buy calls. Some of that is certainly reflected there, but also the fact that it seems like on a longer term basis, people are perhaps not as concerned about the near term vol we're seeing out here in gold. Mark, you do a lot of hedging for clients and things like that. What's your take on the movement we've seen of gold of late and the vol we're seeing out there, and gold's performance as a hedging vehicle in this environment? Would you be recommending clients to allocate towards gold and gold related options and futures, or are you staying away from it?
I've never suggested to people to allocate toward gold, and I think gold is just a complete joke. It is not an insurance product. It is not a safety asset. It is a inflation deflation measurement asset. And considering we're in a deflationary environment, I don't know that I would ever push anybody into gold. Mark, what about you, Shep?
I think gold is a very popular play. Obviously, hard assets, inflationary, deflationary spiral. I think it is a very tactical approach for a portfolio. And I think every portfolio could use a little bit of the industrial precious metals. I do like gold, silver, and even a little copper. It's diversification and it's a commodity. I do agree with the greasy meatball that it's not quite an insurance product. But if you are diversifying your portfolio and it's a tactical trade, I would certainly recommend purchasing at these levels rather than 1900, of course. Mm-hmm. But just a little bit at a time. I certainly wouldn't buy bet the house right now. But why not add a little bit to your portfolio right now? Sure.
All right, and that's going to do it for the volatility review segment. And now we're going to keep on rolling right on into our volatility voicemail.
It's time to welcome thought leaders from throughout the volatility trading world. It's time for Volatility Viewpoint.
All right, and welcome to the volatility voicemail. This is indeed the portion of the program where you guys get to join us on the old Volatility Views panel, make your questions and comments and thoughts and ideas known to us here on the show, as well as to your fellow listeners. You can, of course, reach us in a variety of different ways. Hit us up on the website, just hit on the contact form or post a comment on the site, and we'll, of course, route it to the appropriate show. Find us via questions@theoptionsinsider.com. Just be sure to put somewhere question for Volatility Views, and we'll route it to this program, of course, or via social media, twitter.com/options, facebook.com/the Options Insider, and stocktwits/Options Insider over there. So we are no shortage of ways for you guys to reach out to us on the show. And of course, all that is baked in to the iOS app as well. Not so much on the Android. We're working on that, but get it on the iOS. So no shortage of ways for you guys to make your questions known. Like our first listener here goes by the handle Lax66. He or she writes, "Hey, do you guys know where I can find a list of the pensions and endowments that utilize options and futures for hedging purposes? I like to see if my money is safe and being put to good use. Is that info publicly available?" Now, this is something, Shep, you and I have chatted about many times in the past, and that's something you work on quite a bit over there. That's the reason essentially for the existence of your consulting firm, is to try to help breach that divide there with the pension funds, the endowments, these other big, large funds that, quite frankly, should be hedging with puts and writing calls for income and constructing collars and things like that. And yet, for a variety of reasons, inertia, lack of education, lack of understanding, irrational fear, prohibitions in the funds, all of the above, they tend not to do that. Our listener here, Lack66, asking for the ones that are perhaps a little bit savvier from that perspective. What insight can you share here with our listener, Mark? You talk to a lot of these different funds and you go to these conferences and things. Are you starting to see, first off, before we even get to the specifics of the question, are you starting to see an uptick in the interest on behalf of those funds in essentially what you're selling, which is, using options and to hedge volatility and things like that? Or are they still pretty hands-off from an options and derivative standpoint? And then, of course, the second part, his question, do you know of any specific funds that you think would be are doing it in a much more savvy way than others?
Sure. It's always a sales process, an education process for pensions, endowments, and foundations. And ultimately, it prescribes a situation where these institutions want to have a real-time risk measurement advisor in place. So if they're already outsourcing an investment advisor, it would also make a great deal of sense to have an outsourced strategist and risk measurement advisor to complement their existing portfolio. What I try and do, what I try and sell, is not that it's going to take more time, but it's going to complement their overall portfolio. So if they are concerned about liquidity and transparency of hedge funds, of private equity, of fee structure and all of that, then it would make a great deal more sense to be able to add optionality to the portfolio as a risk measurement tool, because from a visual standpoint, you can see very clearly what is going on in your portfolio. So that's one of the tactics that I try and bring to the table. Now, secondly, to the question from Lax66, if his money is within a pension, that should be online. Any public pension should have all of their investments in a PDF format, and it should be public record. Now, whether or not the chief investment officer will let you see what they are trying to do is another story, but I would certainly reach out to the specific information officer of a pension or foundation where the money is to ask those types of questions. A little bit of research, a little bit of due diligence, you should be able to find these things.
There you go. Well said, sir. Yeah, unfortunately, it does require a little bit of due diligence on your part. There aren't really any good services we can recommend, are there, Shep, that would he could find all this in one kind of place? I'm trying to think of it as we were reading the question, and none really leap to mind. Maybe you're familiar with some other services that I'm not, but essentially, yeah, it sounds like if he really wants to find it out, he needs to do the legwork himself, dig through their prospectuses and things like that. Probably the easy answer for a lot of these funds, though, is no, they don't do much of any of this stuff. So you can probably relatively safely assume that they don't do it, and you can have your own opinion on that, whether that's good or not. I know a lot of people are arguing in our state here, Mark, that they should be perhaps using some more options to hedge, and indeed covered calls for income to maybe help combat some of our pension problems here in this state. We are woefully underfunded. A little bit of income might go a long way towards helping that. But still, a lot of these funds, unfortunately, for a variety of reasons, simply don't do that. We're going to jump now, Mark, to this question here from listener goes by a handle Bailiwick. He writes, "Hey, I'd like to submit a question for the Volatility Views radio program." Well, you sent it to the right place. Well done. He goes on to write, "What is the problem with GVZ? Why aren't there any products to trade with it? I looked it up earlier this week, only to find 0 contracts traded. Did they delist it? You'd think this product would be very popular in a week like this." Mark, this is, of course, referring back to what we were just talking about a little while ago in the Volatility Review, the Gold Volatility Index. It is, of course, the gold VIX, essentially. This is one of the ones, and we talked about this on the show quite a while ago. This is one of those ones that seemed to me like it was a peanut butter and chocolate type thing, two great tastes that taste great together. Gold and volatility, gold and VIX, two great things. GLD, very popular, VIX, very popular. It seemed like this, when they started disseminating it, would be a no-brainer, yet it's not really doing anything. So I think a lot of people, perhaps the SIBO included, were a bit disappointed that this one didn't really resonate with the masses. What's your take on the whole GVZ, the gold VIX thing? Did it intrigue you when they first announced it? Were you one of the ones like me who kind of thought it was going to do fairly well and then were perhaps surprised that it hasn't really done anything? Or are you pretty much not surprised at all with what's been happening out there?
Yeah, I think it's a great idea. I'm quite surprised that it hasn't done better or really done anything. However, it obviously has probably been used as a research tool. So it's just sort of like a free way to look at the market without trading it, if you will. Obviously, some more of your savvy prop traders and other things like that might be looking more directly at the futures market and of course the ETF. So I don't know how much they would spread or cross hedge that specific component, but it certainly makes sense, and obviously volatility hasn't been very very elevated, if you will, over the past few years. But it's just a matter of taste and perspective, I would imagine.
Yeah, you're right. And of course, you can get a lot of that with just trading the GLD product itself, of course, has its own implied vol, but you can make that same argument about SPY and others, and yet VIX does resonate. And yet, for whatever reason, a lot of these, you can call them satellite VIXs, other attempts at VIX, the GVZ being one of them, of course, the OVX being another one. A lot of these other ones, even the single names that they talked about with the Apples and others, none of them, they weren't listed, but the other ones never really resonated with the audience. And so it's kind of a bit of a head scratcher as to what will resonate in the volatility space versus what won't, which is why we're paying so much attention, of course, to the weekly volatility futures out there in the VIX, because maybe that will, of course, change things up. Last up here, we have a question. This comes from Talbotl. I'm not sure how you pronounce that handle. And Mark, this comes from our episode last week. We had guests on from Typhon Asset Management there, and they were talking about essentially kicking the can in VIX by kind of doing your trades beyond that 30-day window where all the froth and the craziness is. And if you get beyond that, things get a lot saner. So that's what our listener is referring to here. He writes, "Hey, let me see if I have this straight. The front end of the VIX curve is where all the crazy stuff happens, so I want to avoid that in my hedges and, quote, kick the can past it. The longer portion of the VIX curve is where things typically get pricey. So am I correct in assuming that somewhere in the midpoint, perhaps around 3 months, is the Goldilocks spot where I should buy my porridge? Is that the most effective place to purchase VIX futures for hedging from a cost to Vega perspective?" Mark, this is kind of the ongoing question out here in VIX land. You trade VXX, so it sounds like you've made the determination to go that route. That product, of course, has issues with the contango. Everything out there in volatility land has issues with that kind of term structure of the futures at the end of the day. I've seen a lot of different attempts to try to ameliorate this. Some people doing what he's describing here, which is kind of focusing on that midpoint somewhere in the 3 to 6 month range on the curve. Others trying to do a basket of maybe some front month, some middle curve, some farther farther off and trying to game the system that way. Obviously, products like VXX, where they're buying long-term expensive vol, selling cheaper near-term vol, they're kind of doing it the wrong way. Hence, that's why I made the reference earlier to how it kind of erodes in your hand. So there's a lot of different approaches to this. Some work better than others, and also obviously depends on the term structure at the time, how effective those approaches are going to be. If you have a relatively flat term structure, then a product like VXX isn't going to perform that badly because it's not being as disadvantaged as it normally would. If you have some weird scenario where the middle of the curve is starting to get some bid up, then the approach you're taking here with the 3 to 6 month range is probably not going to be that effective. If you have, it depends really on the structure as well as how they outlay it. That's why it's kind of hard to say there is one really silver bullet Goldilocks type strategy for what you're looking to do. That said, Mark, you spent a lot of time looking at this. You've leaned into the VXX camp, going that way instead. What's your take on essentially what he's asking here? The VIX Futures term structure. Where, if you're looking to hedge, where do you think is the sweet spot, if there indeed is one?
Sure, it's a great question. It all depends on specifically what he's hedging, and if he's looking for a very short-term hedge, you obviously have to go a little closer to the spot. But that's a very difficult answer or question to answer, just because of those facts which you intimated. It certainly makes sense to, at least as when I try and manage portfolios, to manage to a specific return over time. So not necessarily to put your eggs in one basket. So if he's going to be buying 10 VIX futures 3 months out, then I would say, maybe buy one at T1 now, buy another one a few days later, buy another one at the beginning of next week, and spread them out, ladder them a little bit. So then I think you might have, a better chance to take advantage of those cost scenarios of the skew and some other things as well. So I would just be, advising to make sure he's just not putting everything at risk all at once.
This is kind of the perennial question here with, trying to get that VIX hedge in for the days like we saw last week or 2 weeks ago where the thing popped up to the 20 handle and then started drifting back down. You want to have exposure to the upside in those times, but being able to cost effectively do that over the long term, that is where the challenge comes in. And of course, hence we get questions like this quite a bit. And in his approach, I've certainly seen people riding with worse. Doing it the way VXX is certainly would qualify as perhaps worse in a lot of scenarios. But again, that just leaping out to the long term is kind of challenging for people too. So I think that laddered approach makes certainly a lot of sense, and that's certainly why a lot of funds have taken that similar approach to laddering across the months as well, and trying to get some sort of semblance of exposure to all different parts of the curve, because it's really a thing in flux. You never know which part of the curve is going to be more favorable to you at any given time. So that's why you see these a wide variety of approaches. I encourage you to look at a lot of these funds out there too and see how they're laddering their trade to try to ameliorate the contango, and maybe you could learn a little bit of things or two from them, because it is interesting to see just so many different approaches to it, and no one's really solved it. No one's really got that silver bullet because it doesn't really exist. It depends on the scenario that's going on right now, the context, a lot of other things we said on this show before. Volatility always has a context, and that's going to impact which strategy you want to implement. That said, yours, not terrible. I'll give you that. All right. Let's see. That's about all the time we have for the volatility voicemail for this week. And now, without further ado, let's keep on rolling into our final segment. It's time for the crystal ball.
It's time to peer into the future and reveal what the volatility gods hold in store. It's time to look into the crystal ball.
All right, and welcome to the Crystal Ball. This is the portion of the program where we speculate wildly and sometimes perhaps even recklessly on what the future holds from a volatility perspective. Mr. Shep, I'm not sure you knew what you were signing on for when you came on to the show today, that you'd have to throw caution to the wind like this. But I will give you pride of place to start off here. Of course, this is where we're looking ahead to the week that's to come from a vol perspective. We are, of course, as we are finishing up the show here, hovering right around 14.5 in the VIX Cash, S&P off over 1%, 1.1% now. So interesting times here. What's your take? Where do you think we're heading towards the end of next week? Back down where we were, maybe in the 12 handle range in VIX Cash land? Are we going to do one of these crazy pops to the north, up to the 20 handle? Where are you thinking from an overall S&P implied vol perspective next week?
Sure. I think as earnings season winds down, we're really looking for a macro play right now. So with the 10-year hovering around 226, the German 10-year at 70 basis points, I think with a continued focus on China and their stock market and the commodity super cycle bust, as some are saying, I think we could get back to 19 per chance. But we are into the summer doldrums now, and I would just be proactive in taking advantage of volatility, either from starting your hedging program right now, or if you were good enough to get in the 12, 13 handle, just be prepared to take some off the table, because this market could certainly rip a whole lot higher with some good news out there.
All right, and Mr. Greasy Meatball, where are you leaning next week? Are we hovering back where we were? Are we hovering here? Are we exploding to the upside? Where are you feeling?
I feel like this commodity sell-off has gotten a little overdone. It feels like somebody's getting liquidated, and that's what's pushing things around a little bit more.
They're busting out the Hunt brothers again.
Yeah, no, I've heard that there's a fund that is being forced to sell that is leading all of this down. And so I feel like some of this commodity sell-off's a little overdone. The Fed's not going to be raising rates. People are going to figure that out. And, I would be unshocked if we don't have a green week next week, to say the least. And I would be a buyer of the S&P here. Some names that I really like. I was looking at ExxonMobil, and I can buy August. They have earnings next Friday. I can buy August at the money calls for about the same price as the move that they're down today. So I don't think they've got the vol right in a lot of the diversified oil or any of the oil names. GVZ gold could be a lot worse. Could get a lot worse. I think gold is about to have its second oil-like move. Oil, we just had kind of somewhere in between 2008 and 2011 type of move in oil. We've already had one of those type of moves in gold a couple of years back. I think we could be in line for a second one. I would not be surprised to see gold get to $800 an ounce.
Oh, there you go. So you're buying into the people who are bidding up that
in the sell the world trade, which is the only good reason to own gold.
There you go.
And really, if you want to sell, if you're a believer in the sell the world trade, don't buy gold, buy bullets.
You're in the zombie apocalypse trade business.
Well, yeah, I mean, really, if you want to hedge against kind of the world getting crazy, buy bullets.
Yeah, good luck getting delivery on those gold contracts when the world is spinning to pieces. That's the old joke about selling like the S&P 300 put. Same thing. You're not going to have to worry about that really coming to pass, because the world will be on fire by then. All right, there you go. Two different perspectives on vol, and of course that's all the time we have for the Crystal Ball segments. Also all the time we have for this episode of Volatility Views. But before we go, as always, let me check in with each of my cohorts here on the old Volatility Views panel. See what they have cooking that may interest you. Mr. Shep, we'll give you pride of place as our guest. What's coming down the pike for you, and where should our listeners go if they want to learn more about what you're working on over there at Derivative Strategy Consultants?
Obviously, the website, derivativestrategyconsultants.com. I'm also going to be participating at the Institutional Investor Conference here at the Four Seasons Chicago in mid-October. So that is always a wonderful time to network, learning experience, and I'll be there for 3 days, and look forward to meeting some people.
And Mr. Greasy Meatball, take us home. What's coming down the pike in the land of the pit?
Just go and read our blog. We try and write something thoughtful every day. We were kind of calling this Amazon thing earlier in the week. A name that I think is, if you're looking for a name to get short that's really hot, the name I like to get short is Tesla. The Model X looks like a Ford Focus, and it is ugly. So that's going to be a problem for them.
There you go.
But we're looking to launch as a sister company, separate sister company. There's going to be we're going to be launching a hedge fund probably late next month, which stay tuned for official announcement. But obviously, you have to be a qualified person to even get information from me. So, if you're a qualified person, I'm happy to talk to you.
All right, there you go. Hit them up over there at the pit, or just stay tuned for further announcements. And on behalf of one Mark S. and the other Mark S., and indeed myself, I want to thank all of you out there in the listening audience for downloading and streaming and subscribing to the show, and of course for sending in such great questions. Keep them coming. And we'll see you next time right here on Volatility Views.
Thank you for listening to Volatility Views, the premier program for volatility traders. For episode archives and detailed show notes, please visit theoptionsinsider.com/volatilityviews. Be sure to make your own voice heard by leaving a volatility voicemail at 773-669-4VOL. or by posting a comment on theoptionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/theoptionsinsider. Volatility Views is brought to you by Russell Investments, a global asset manager and one of only a few firms that offer actively managed multi-asset portfolios and services that include advice, investments, and implementation. For more information on Russell indexes and RVX, please visit russell.com/indexes.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.